These green lines represent if the third wave is equal to the first wave, it would take gold to 2566, a 1.236% extension to about 2600. And if it's what's called an extended third wave, it could go as high as a 1.618% extension. And that's getting you, just close to 2675. Now, here's the key. That being said, even though we believe that gold could shoot up substantially higher, there is a fractal quality to Elliott Wave.
The recent significant profit-taking in gold had an outsized effect on silver prices. However, market volatility is starting to calm down, with growing expectations that the Federal Reserve will cut interest rates by the end of the quarter. This week, the WGC published its Gold Demand Trends Q2 2024, and despite record prices, the organization saw record demand, with OTC investment demand from family offices and rich individuals, as well as continued demand from central banks as decisive. GaryWagner, editor at thegoldforecast.com, delves into the recent shifts in the gold and silver markets. While analyzing Elliott Wave patterns, Wagner predicts that, following a deep correction, gold is likely to enter a strong third wave bull run, with potential price targets up to $2,675. Technically, the longer-term charts point to corrective pullbacks for the gold price, but risk aversion and the potential for broadly lower interest rates continue to underpin gains for the yellow metal. Despite the anticipated rise, Wagner expresses that Wave 3 will exhibit a fractal quality, stair-stepping up in smaller increments. Regarding the Federal Open Market Committee meeting, Wagner predicts a dovish tone, interpreting it as an indication of accommodative policy and a readiness to initiate a series of interest rate cuts. Gold completed a strong second quarter in 2024, hitting multiple new highs in April, May, and July. However, in June, the metal retreated a little as U.S. interest rate cut forecasts were pushed out, and physical demand started to soften in response to the high prices. The rebound in July appears driven by the market's expectations of U.S. rate cuts becoming more optimistic once again. Now, we present the clips of Gary Wagner's insights from his recent interview. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
The chart that we have up is a gold chart, and we're looking at was a full count up to 5, and that 5, of course, you can see finished here, and then we went into a correction. The correction that unfolded was the descending top flat bottom that we've talked about. We've identified this pattern twice now. We also talked about how once gold broke above this upper level resistance line right here that's drawn from a series of lower highs, it's called a thrust. And I explained it last week as if you think of winding up a spring, every time it bounces from the high to the low, that spring tightens. And so when it does break above this, it releases energy and you get a sizable move fairly quickly, and that's what we witnessed. And so this is what I'm labeling as our wave 1. Our wave 2 saw gold correct from this high here at about, this is December gold now, 25.29 down to these lows at about 2,400. That was actually almost a 78% retracement, exceedingly deep correction. It's a strong correction, but acceptable. What cannot happen is for this low to go below this point or the starting point of the wave 1. And I now believe that we are in a wave 3. Typically, when we do basic models for a wave 3, wave 1 is what is called a benchmark wave. So once we have that in place and the wave 2 is completed, then we can start plotting where a third wave could go to. And it's also how I came up with the forecast for the end of the year and Q1 last time, is I measured the distance from 2353 up to 2527 and began a fib extension from 2403. So these green lines represent if the third wave is equal to the first wave, it would take gold to 2566, a 1.236% extension to about 2600. And if it's what's called an extended third wave, it could go as high as a 1.618% extension, and that's getting you, just close to 2675. Now, here's the key. That being said, even though we believe that gold could shoot up substantially higher, there is a fractal quality to Elliott Wave. So within a impulse wave 3, you can then subdivide it into a smaller count, typically 5. You can get a 3 count, but so this wave 3 can be looked at as a 1, a 2, a 3, a 4, and a 5. So it's going to stair step up. And the key to what we're looking at is there's a couple of golden rules in Elliott Wave. And one of them is wave 3 cannot be the shortest of any of the impulse waves, which is why when we do our upside prediction, we look at a minimum of a 1-to-1 relationship between this wave and the current wave 3. But it's exciting times that we have this kind of potential. It allows us to be effective traders because we can look at the fundamentals at play. In other words, my belief is that the tone of the conclusion of the FOMC meeting will be interpreted as dovish. It will be interpreted as accommodative, and that they are ready to initiate interest rate normalization. They do that by cutting rates the first time. But as we talked about on the last show, it's so much more than that because it's not a single rate cut. It's a series of rate cuts between now and the end of 2026 to normalize interest rates.
In his assessment, GaryWagner explains that while technical patterns are important, they ultimately reflect underlying fundamental factors driving the market. He anticipates that a reduction in inflation may prompt the Federal Reserve to lower rates, which would likely benefit both gold and equities. On Wednesday, Federal Reserve Chair Jerome Powell set the stage for the central bank's first rate cut in 4 years, citing greater progress toward lower inflation and a cooler job market that no longer threatens to overheat the economy. Still, the Fed kept its key interest rate unchanged at a 23-year high of 5.3%, despite calls from some economists and Democratic politicians to implement a cut Wednesday. Instead, Powell said that if inflation continues to fall, a reduction in our policy rate could be on the table when the Fed next meets September 17th and 18th. According to Wagner, lower borrowing costs benefit business investment and make gold more attractive than fixed income assets. He also emphasizes adjusting trading models to reflect current market conditions. Let's get back to the interview.
I am a market technician, but I believe that fundamentals obviously drive the market. A market doesn't move to a certain point because the technical theories and studies you're using suggest that. They suggest that price point because it's a logical move based on the fundamentals. So the first thing to create a trading model is to look at the fundamental environment and decide if, take for example, the last inflation report. We were under the assumption that the inflation report would show that inflation has cooled slightly, and lower inflation opens the door, let's say, for the Federal Reserve to actually beginning to cut rates because they need to see certain criteria met and they want to get inflation to their 2% target. One of the interesting things that Chairman Powell said recently, and this was at the Economic Club of Washington, and they asked him are you going to cut rates in September? And his response was typical Fed speak. He says, well, I'm not going to address that, but I will tell you that we're not going to wait till inflation gets to 2% before we cut rates. That's what I mean by Fed speak. He didn't say, yes, we're going to cut rates in September, but he also opened the door for a rate cut because inflation isn't at the 2% target, but they have the confidence that their moves that they have done, the restrictive monetary policy of raising rates 11 times and then pausing about a year ago, has got a lag in that it takes time to work itself through the economy. So by saying that they're not going to wait till inflation hits that 2% target was a veiled way of saying that we're ready to cut rates. And so it's reading between the lines. So if you have the belief that a report is going to yield a certain outcome. And you also have knowledge that typically that is bullish or bearish on a market. In other words, when interest rates begin to get cut, it's going to provide strong bullish tailwinds for both gold and equities. In terms of equities, the less amount there is to the cost of borrowing capital for a business to grow, the more they're likely to take on development projects and to move out into the future and spend the money now in order to capture it later on. In the case of gold right now, gold doesn't yield interest. So interest rates were down at 0.25% or 0.5%. Gold was a pretty attractive asset class because you're taking risks, but you can make a decent return. But once interest rates went up to 5%. Now the investors are looking at, I have a guaranteed fixed return of 5% with no risk, whether it's a CD in a bank or whether it's a bond, and take very little or no risk, or I can have a substantial or reasonable amount of risk and not have that same guaranteed return. I'm going to not see gold as an attractive of an asset class as it is when interest rates move down. And so that's why it's bullish for both gold and U.S. equities. That is rate cuts is what I'm referring to. So as long as you believe that to be the case, that's how I would create a model. Always go ahead and back test it. Always work with it to make sure that it has decent results when you back test it, and then realize that just because it performed on paper historically doesn't guarantee it's going to do the same thing in the future. Nothing does. And so it's a matter of feeling comfortable with the techniques that you develop. You can work with market managers, whether it's a fund or other institutional traders that will do that on your behalf, or develop a model on your own.
Having hit new all-time highs in 2024, the 2025 gold price forecast also looks positive, with many analysts expecting further new records. U.S. interest rates and the dollar, a U.S. presidential election, an ongoing conflict in Ukraine and Israel, central bank buying, and higher consumer demand in China will all have a part to play in affecting the gold price in 2025. How do you think upcoming Federal Reserve decisions will impact your investment strategy in gold and silver? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.